Good morning, everybody, and welcome to today's edition of NCCPAP Now. I'm Neil Fishman, Chair of the PR Committee and your host for today's presentation. Before we get started, we do have a little bit of housekeeping that we need to do. First of all, it's very important that you have your first and last name in on your Lincoln so that we can make sure that you get your CPE credits. Since this program is our first one going for an hour and a half, you will be eligible for an hour and a half, 1.5 credits of CPE. There will be polling questions during the program. It is important that you answer them in order to receive the credits. So please pay attention. They will be announced when they're happening. If you have any questions regarding the CPE, you can contact Alexandra at the NCCPAP office. You can either call her at 516-333-8282, or you can email her at execdir@ncccpap.org. We hope that you will find this program interesting, enlightening, and illuminating. We will have one more program scheduled for the end of October on October 24th, which will be the week leading up to the next national meeting, which will be held October 26th, 27th, and 28th in Dallas, Texas. And as everyone is aware, anyone can come and attend either by Zoom or come to Dallas and really see what goes on at a national meeting. So the slides that you will be seeing will be made available, as will a recording of this program within a few days. As you can see the link there on the NCCPAP website. You can go there. You will be sent an email when the program is available on the NCCPAP website, go.ncccpap.org, events, NCCPAP Now. So actually, before we get started, we do have our first polling question right now. So everybody, if you'll take a moment and respond to it as quickly as possible. You have about 1 minute. Before we go to our first speaker, we do encourage you to ask questions through the Q&A. Some questions will be responded to at the end of each presentation, and we will hold on to some others to ask at the very end of today's program. So our first speaker today, as is our president, Mark Stewart. As everybody was probably aware, last week, this weekend, there was a major event going on within the United States Senate chambers, the passage of the Inflation Reduction Act. This was actually a smaller version of what was originally known as Build Back Better. And to talk about that, I'm going to turn this over now to our president, Mark Stewart. Mark.
Thank you very much, Neil. And yeah, we cannot possibly be having a more timely NCCPAP Now session, given the events over the weekend. As I'm sure most of you are aware, the Senate did pass along party lines this Inflation Reduction Act of 2022. And we will not sit here today and debate whether it actually reduces inflation or not. We'll just talk about the actual provisions that affect us as practitioners and our clients as well. For those of you that follow the way the legislative process works, this bill will be taken up in the House probably this Friday. It's almost a lead pipe cinch to be passed on Friday, so we can assume this is going to become law and can talk about it as such. Big highlight, at least for us at NCCPAP, is we finally do get the desperately needed funding for the IRS that we've been asking for a very long time at this point. It is important to go over and kind of note how the dollars are broken down. So this $80 billion, you see I have highlighted there enforcement is $45 billion. As an organization, we've actually supported having any types of allocations made to IRS funding to be more towards taxpayer services, modernization, and support. As you can see here, enforcement, if you take all the other items combined, is more than all the other items combined. So the enforcement is a very big piece. Again, we supported at NCCPAP, not having the enforcement be as big a piece, but that is what they seem to have landed on here. Keep in mind when it comes to enforcement, you hear a lot of things bandied about that, enforcement will only affect the millionaires out there, and the everyday taxpayer shouldn't worry about that. I think we all know as practitioners that that's not true. And also, as we know, people have one-time events in their life that temporarily make them a millionaire in a given tax year. Maybe they finally sell their family business or something like that. Puts them in technically the millionaire status for that year. So just know enforcement is coming. We all have to be prepared for that. We have to be prepared down the line for more audits. We have to see how this is going to affect the actual backlog of paperwork that the IRS is dealing with. Remember, the IRS is going to have to catch up on their backlog, honestly, before they do anything else. So we're really going to have to see how this plays out. It is, again, not exactly what we wanted, but it is something, okay, that we finally got funding for the IRS. So we do view this overall as a positive, but again, we do have concerns about the enforcement being such a big piece here. So stay tuned, guys, to see how that plays out. I'm sure as you guys are following the news here, one of the big topics of discussion back and forth was this concept of carried interest. And I did want to spend a little bit of time on it. Now, as you guys have probably read, the changes to carried interest were actually removed from this bill at the last second, for the most part, as a concession to Congresswoman Sinema. But let me kind of dismiss some myths here and highlight what goes on with carried interest and why it's important. Big thing to take away from the seminar today is anything you're hearing on the news, anything you hear from politicians about any of these provisions closing the loophole on carried interest is just not true. It's a talking point. Any of the things that they were talking about were just changing when the carried interest loophole kind of phases in, phases out to different taxpayers, and I'll get into that in a second. Other thing is, with this being removed from the bill, it actually wasn't a huge revenue raiser in the bill, believe it or not. It was actually only $14 billion of revenue raising, which actually, as it comes to bills these days, is not that much. Now, let me just go very briefly, because you could have a 3-hour seminar on carried interest, but it's important for us to understand what it is. Well, it's very complicated. It just basically entitles the general partner of any investment fund to share in the fund's profits. Investments can take any form, but very often it has to do with business startups or investments in private businesses and helping them to take them public. But again, it could take many, many, many forms. How's it structured flow-wise? Well, the various investments pass profits to a general partner in a form typically afford the capital gains rate treatment. And that really was the argument back and forth here, when capital gains could be afforded to these hedge funds type managers. In these arrangements, the general partner then typically passes profits to various investment managers who are often afforded this preferential capital gains rate treatment. So that's at a very high level how carried interest works. Again, you can get into literally an 8-hour seminar as to who it does or doesn't apply for. But what's important as a practitioner is to know, well, when do I typically have a client that's dealing with carried interest? Well, you have any client that's any manner of hedge fund manager, they work in private equity firms, they are almost always compensated in some way with a carried interest arrangement. So if you have a client in that industry, be aware they're more than likely going to have some type of carried interest arrangement. This typically entails receipt of a K-1 detailing the carried interest arrangements. Now, what's very important to understand is the carried interest rules, which I'll get into in a second, all right, will be disclosed to your clients in the various notes to the K-1s. So if your client is an investment fund manager and they send you over the K-1s and it's just page 1, 2, and 3 of the K-1, that is not enough detail for you to properly prepare their tax return. One thing to keep in mind is there was all this talk about closing the carried interest loophole in these discussions back and forth with the Inflation Reduction Act of 2022. However, a lot of people are not aware of is back with TCJA in 2017, there was also this big talk of closing the carried interest loophole. At that time, they actually did change the carried interest rules. And essentially, more or less, the rule was changed whereby capital gains rate treatment can only be afforded to these hedge fund managers, investment fund managers, if the underlying investments were held longer than 3 years. So all of a sudden, it instituted this new concept of capital gains 1 year, capital gains over 3 years. What they were talking about, by the way, in the Inflation Reduction Act of 2022, before the change that was made to push it over the deadline, made it removed from the bill, is they were just changing that holding period for the underlying investments from 3 years to 5 years. And there was also going to be an exception in there for people at age under $400,000. But that's all they were talking about, folks, is moving the goalposts from 3 years to 5 years. So any of the talk that you heard about closing the carried interest loophole, just not true. It wasn't true back in 2017. It wasn't true now. They're just changing when it affects a hedge fund manager and what the underlying investment holding period has to be afforded preferential capital gains treatment. Now, getting back to what I was talking about before, there is nothing on the front of a K1 that says when a capital gain on that K1 is from underlying investments over 3 years or not. This is what I was saying before. When you're dealing with a client in this sector, you have to make sure you get the full packet K1. You need to read through. If there's 40 pages of notes, you got to dig through those 40 pages of notes. There's other things important in those notes, but you got to find that schedule of over 3 years or not. In addition, very often these K1s are items or investment funds that go on extension. So when you get those estimates at extension time, you better get estimates that show those gains over 3 years or not over 3 years to properly prepare the extension. So I did want to spend a little bit of time on carried interest. It is very important. What went on here in Congress did highlight an issue that I think a lot of us are not necessarily paying as much attention to as we should, because this
Mark,
change back in
polling question
2017
queue is up.
Thank you very much, Neil. So this changed back in 2017. It could come back again. It could change again. But I have a feeling the loophole will never be changed. Just the goalpost for the underlying investments over time is going to change. So just be mindful of that, folks. It's very important. And this, what went on in Congress now did bring to light what was going on there and what was so important about it. So this Inflation Reduction Act had a ton of new provisions that affect us in it that I will go through and try to highlight. You could have, it's a 755-page bill. You could have an 8-hour seminar on any of the particular provisions. I will try to go through them as much as possible and highlight them as much as possible. What essentially replaced as a revenue raiser for removing the carried interest provisions in this bill was a 1% excise tax on stock buybacks. Now, you might think that that might not apply to your client, but it definitely can. From what I've read in the bill so far, it only applies to buybacks in excess of $1 million. But you very much could have your small business client where, mom sells out to daughter, father sells out to son. Well, that could easily be over $1 million, and this excise tax could affect your client. So it might affect how businesses and acquisitions and sales are structured. It might structure sales against buybacks into some other forms. So just keep it in mind. There's going to be regulations coming out on this, but pay attention to it, especially to your small business clients and when they're trying to structure some sort of sellouts, particularly amongst family members. In fact, as we read the details of this, they could have a carve out for family members. We really don't know. This is really brand new. As I'm sure you guys have read about a lot, there's this concept of a 15% corporate minimum tax on adjusted financial statement income for corporations with profits in excess of $1 billion. Now, look, as we all know, none of us have clients in this sector, or if you do happen to have clients with more than $1 billion of profits, congratulations. But all joking aside, we don't have clients in this sector. However, as an organization, as NCCPAP and MES, we should be concerned about this conceptually because they're taking a financial statement concept and bringing it into the tax world. And do we really like the kind of slippery slope that this potentially has? Now, understand there's concepts in the financial statement world that just simply don't exist in the tax world. For example, I'm just picking one, materiality. You can't normally talk with a tax auditor from the IRS and go, well, I left this out of the profit base for taxation because I didn't deem the item was material. Well, as you all know, in the financial statement world, there's a ton of items that are immaterial. With a big company, a $500,000, $1 million item can be completely immaterial. So it kind of remains to be seen how the financial statement world and the tax world kind of marry themselves with this. And there's going to be a ton of regulations on it. But I think we have to be cognizant of the fact of, do we like all of a sudden the financial statement world kind of sliding into the tax world? And do we like this concept of book income and tax income kind of blending together and the line becoming hazy? So I think it's something we have to worry about. I think it's something conceptually that we might want to push back against. And it's not pushing back against taxing the bigger, more profitable entities, because we probably can make an argument for that. It's how this is being imposed. And we maybe should be concerned about that and how the structure came about. There's something to keep in mind, something to think about as the regulations come down on this. Other big thing we saw in here has been an extension of the ACA subsidies through 2025. Now, we all hate these, okay? And not conceptually that there are subsidies, but the fact of what it does to us as practitioners. All of us have gone to file a tax return electronically, and we get that electronic bounce back. Sorry, your client had an ACA subsidy, a potential premium tax credit that we have to review. Go back and ask your client. And we've all had the situation. We go back and ask our client, why didn't you tell us about this ACA subsidy that you got? We put it on the questionnaire for our tax return. You answered no. And the fact of the matter is clients are just not aware of this. It's not top of mind. So unfortunately, folks, we're going to be dealing with this through 2025. It's a sore point for us. We're going to have to keep asking our clients about it, keep getting copies of those 1095s. You know, we're just going to have to get in the habit more and more of responding to our clients on this. Now, one thing I do applaud the IRS on this is in earlier years, there was no e-file rejection when this happened. You just sent the return to the IRS and a notice came back, all right? At that point, now we get kind of the proactive measure by the IRS. Hey, your return got rejected. There's a potential premium tax credit here. Go back and fix it. So that's a good thing, but it's annoying as a practitioner. So we're going to be stuck dealing with this gang through 2025. And if you read the tea leaves, it's probably going to continue past 2025. There'll be legislation at some point that kind of brings us forward into the future. So we just have to accept premium tax credit. We're dealing with it in perpetuity and just kind of accept that as a fact of life. The prescription drug pricing negotiations were interesting. So to kind of give you guys some color on this, even though it's not exactly a tax concept, I do think as practitioners it's important for us to note. So what they were talking about here just is particularly linked to Medicare, all right? So this is not helping people outside of Medicare. That's point one. Point two is this only starts applying in 2026, all right? So again, things that are political talking points, honestly, on both sides of the aisle about this providing relief. It will provide no immediate relief. Now, if you read the tea leaves from drug companies, is they're not in the business of losing money or having their profits curtailed. So as this comes into play, will A, the drug companies increase prices on everybody prospectively or now, okay, to kind of, build into the fact that they're going to have their knees cut off them a little bit in 2026. And, all of us can have a logical argument about whether the prescription drug companies should have their profits somehow curtailed. But I think we can all agree that it should probably help everybody and maybe just not folks on Medicare. And if you do help folks on Medicare, even in 2026, is it going to affect the rest of the population where the drug companies compensate for that? So that's kind of going to be a to be continued, folks. We have to kind of see what happens with that. But it's going to be very interesting what goes on with that going forward. Now, the biggest piece of this legislation probably was in support of things to curtail climate change. And we can all argue whether the bill has a positive effect on climate change and whether you should be putting climate change in and whether you're for that or against that. That's not what I'm going to talk about today. We have to set that aside as practitioners. We have to set our political differences aside as practitioners. It's going to be the law of the land now. We have to deal with the fact that they put in a myriad, of energy tax credits when it comes to this bill. So the kind of running joke that I'm starting here is if your client calls you and says, I did such and such, I should apply for an energy tax credit, your immediate answer to them should just be yes, okay? Because there are so many different credits in this bill. All right, too many to count, honestly. Where your client says that they did something, it probably does apply for a credit. Now, the other thing is, various companies are now going to be calling and contacting your client saying, hey, there's this new credit out there, and your client's going to be told, you apply for it, you're going to get it, and don't even talk to your tax practitioner. Just go and buy such and such, and you're going to apply for this credit. Okay, you're going to, qualify for this credit. So we're going to be the backboards of this to try to explain to our clients that no, you might or might not apply for these credits, be it the various credits having AGI limitations or not being effective yet, only being effective for a couple of years, or the credits are smaller in early years, larger in future years. There's a myriad of things that affect these credits. And we're going to be the backstops for our clients on this. We just have to expect this. And our clients are going to be angry at us. They're going to say, no, the person that sold this to me said that I could get this credit, So we already have these arguments now, when it comes to some of these energy credits. They're only going to be ramped up, all right? That's the first thing. Second thing is on the flip side, where clients are not aware that they're eligible for these credits. And we really have to make this now kind of, top of mind. And, if you guys are using, like a lot of us are, questionnaires for your clients, you almost have to move the energy credit thing right to the top of your questionnaire. Because there's going to be a lot more people eligible for these credits now. There are a ton of them. And I'm just kind of, go through them rapid fire and highlights the ones that are, most interesting in there, because there are a lot of them. The first ones I have on screen, which are the residential energy tax credits. These are ones we're already familiar with. They're not new. So we have the residential clean energy credit and energy efficient home improvement credits. These have been around for a long time. But what this does is it extends a lot of these through the early 2030s. And all these credits have various end dates on them. But we are familiar with these, and these are now all expanded and are going to be around now for a very, very long time to come. So just expect that and expect your clients' questions on these. Massive expansion now as to vehicle tax credits. A couple of things to keep in mind. One, you're probably aware with a lot of these credits in the past that they limited the amount of production that could qualify for these credits. And a lot of times it was only the first 10,000 or the first $25,000 vehicles that rolled off the line were eligible for these credits. That's no more. They've lifted these from manufacturers. That's the first thing to understand. Second thing to understand is there's been given preferential treatment here for American companies. And I'm not going to get into the specifics on this, but it's not only going to be buying clean vehicles or what's called energy efficient vehicles, but it's also going to be preferential treatment to American vehicles, GM, those types of companies, right? So you have to keep that in mind, when you're talking to clients about making these decisions and whether to purchase these types of things. Other interesting thing in here, which is new, is they added a previously owned clean vehicle credits. These have been involved for a while. So if somebody goes to a dealer and a dealer has a used, energy efficient vehicle, that will now qualify for a credit. So you have to think about, now what's happening in the economy. There's the same vehicle churning and churning and churning through. And I believe I read in here, it has to be a 2-year period before it can churn back through for another credit. But as time goes along, these things are being resold and resold and resold. And there'll be these credits over and over and over again on these things, which is actually interesting. As people buy their clean vehicles, there will also be a charging station credit. So as folks put charging stations in their own homes, in their own garages, there'll be a credit for that. So there's a big incentive not only to buy energy efficient vehicles, but to also put fueling stations in your homes for these vehicles. So that's going to be big, big dollars for your clients as things move along. There are a ton, and I cannot get into these individually, as we'd be here all day, of what they call production tax credits, hydrogen production tax credits, and manufacturing production tax credits, nuclear production tax credits, renewable energy, new clean electricity tax credits, on and on and on and on and on. So if you have clients in these sectors, literally it's going to be Christmas, okay? And there's going to be a ton of money for these clients. Now, if we go back to what we were talking about before, there's a little bit of give and a little bit of take. Some of the biggest companies in the world are involved in these. They have over $1 billion of profits, but these credits wipe out their taxable income. They're still going to be subject to a tax, So there is some, guardrails in place here for people taking advantage of these, but there is a massive, massive amount of dollars at play here. There's also various investment tax credits that relate to energy here. Just a general energy investment credit, electricity investment credit, what's called the Advanced Energy Project Credit. Again, on and on and on as we go through this bill. A ton of what's called just general fuel tax credits, all right? Clean electricity investment tax credit, fuel production credit, sustainable aviation credit. I could just be listening to these things on and on and on. And I want to understand, folks, I put in the slide here just the highlights, just the most important ones. There's probably hundreds, okay, of credits in this bill when it comes to that. Mm-hmm. On top of the credits, okay, there's a ton of grant programs that were established for energy companies in here. So not only the energy companies getting all these various credits, okay, for various things that they do, but they're going to get a ton of grant money to start various energy projects as time goes along. So you might or might not have clients in this sector, but you're going to have some clients, at least individual clients with the residential energy credits and such. So you have to kind of change your modus operandi here as a tax preparer and give some thought as to what you're going to do here. So you have to start asking your clients, do you have or did you buy any energy efficient property during the year? Same thing goes for your business clients if they got involved in any of this. It has to be asked of your clients, number one. Number two, you're going to be the backboard for your clients if they don't qualify for these credits. And maybe as you talk to your clients during the year, some of us have sort of kind of mid-year reviews with clients or reviews with our clients for tax planning purposes of the 9-month goalpost. Kind of talk to them a little bit about these energy credits and when they do and don't apply, and kind of dismiss the rumors that they're going to hear from folks out there, because there's going to be a ton of rumors out there that they're going to hear, and they might or might not qualify for these credits, or they might qualify for the credit, but they're not going to get to use it in the first year, and they're going to have to carry it forward. So very, very, very important. Getting back to what I was talking before about the ACA issue, all right? Talking with your clients about that, that's going to be around for a long time, and making sure that they're aware if they apply for a premium tax credit or not, because as you know, by the time you get the bounce back, it's going to delay their refund a lot. So there's a lot to digest here, folks. There's a lot in this bill. And what you all have to understand is there's the bill and then there's the regulations that come out after it. And even though this bill is 755 pages, the regulations that come out about this are going to be 7,555 pages on this. So we're going to have to kind of sit back and see how the regulations shake out on this. The 15% minimum tax on financial statement income probably alone will have 7,000 pages of regulations on this. So we have to sit back a little bit here, okay? We have to breathe a little bit, see how the regulations come through on this, because there's going to be a ton of them going forward. So this is a game changer, folks. There's a lot in here. The IRS funding is beyond the game changer. And the fact that they focused on enforcement is huge. $45 billion for enforcement. There are going to be a ton more audits. It goes without saying. And the one thing I'll kind of leave you with in my part of the presentation is it will affect all taxpayers. There cannot possibly be enough revenue raisers just from the upper 1%, as you kind of hear them talking about. It's going to affect our clients, folks. We got to be ready for it. We got to budget our time as practitioners to be ready to deal with more audits as we go forward here. So I believe poll question number 3 is going to come up now.
Okay.
And as we go forward here, Neil, is there any Q&A as we start?
Yes, actually, we do have one question for starters. The question is, how is this handled by the investor who is paying a commission of, say, 20% of the first few days of profit when an IPO goes public? Is this a reduction of their cost per share? Is it an expense, or does their basis remain the same? Very interesting question on that. So they actually bandied about this topic. Originally, when they were going to change the carried interest provisions, there was items in there about basis changing, okay? At the moment, our understanding, and we have to see the future regulations on this, is there will be a basis adjustment in that instance. Now, there's a little bit of a to be continued on this, because there is likely to be brought back some manner of bill that changes the carried interest rules. It might be just a regulatory type bill that addresses the basis type issues that you were talking about there, whoever asked the question. So the carried interest bill is likely to keep being brought back up and keep being snuck into legislation. Also keep in mind, I should bring this up as part of the question, the carried interest item is actually not a Republican item, not a Democrat item. This is now a Republican regime and a Democratic regime that is went after carried interest. So the carried interest loophole, as they call it, is likely to come back around, even if there's a Republican regime coming back in November. And if they change the carried interest rules, then
even the interest rules around expensing and basis are likely to be changed then. So honestly, folks, there is nothing definitive on the carried interest rules. I have a feeling under a Republican regime, it'll come back up again and the rules can change again.
Thank you. I do have one other question for you, Mark. With the change in budgeting, especially for enforcement, do you think that for those of us who deal with resolution issues, that we will be seeing a increase possibly in people seeking us out to assist them, with more people, especially younger people, doing tax returns on their own?
Yeah, and that's, an expectation here, Neil. And that's what I was, kind of getting into a little bit before about budgeting our time. We're going to have to pivot a little bit as practitioners, with our own clients, with an expectation of we're going to have more audits. Also, guys, think about that in terms of, billing and fees, and we're not going to get into that. For those of you that kind of bill into your fee, hey, there could be a potential audit here. You might have to build more into your fees when it comes to that. And yes, Neil, as you said, the folks that quote unquote TurboTax it, if they're audited more naturally, they might come to us as practitioners. So that's a very real possibility here, Neil. In fact, I'll even say stronger than that. It's not a possibility, it's an absolute certainty that will happen.
Thank you. I do one last comment, and then we will turn over to our next portion. I do know that when I was attending MPL meetings, that the IRS would announce periodically tax returns that they would be looking at for audits. They would look at tax returns that had specific things like a Schedule C or a large medical on Schedule A and so forth. So this is something we will all have to keep our eyes out for. Thank you very much, Mark. We're now going to move on to our second presenter. Steve Mankowski, as everybody knows, is our primary liaison to the IRS. He is our primary representative at the monthly National Public Liaison meetings at the IRS. So without any delay, Mr. Mankowski.
Thank you, Neil, and welcome everyone. As I start off my presentation, one of the items that we had been discussing at last week's national meeting was that with part of NCCPAP Now, we've been getting new members coming in, non-members that have been attending, and just wanted to spend a few minutes at the start just giving a little background as to what some of us at NCCPAP have been doing from a role of the tax committee. So there's a couple of different areas. One is that we advocate for changes affecting practitioners as well as taxpayers. A lot of that, as Mark had alluded to during his presentation, we're starting to see some of the byproduct of some of it. And even as it is, when there's items that end up as some of the collateral damage out of some of these bills, the advocacy that we're doing behind the scenes, and in a lot of cases working with the AICPA and other large national tax practitioner associations, are really working for the betterment of the profession. When we do our advocacy, we're doing that with the IRS, the Joint Committee on Taxation, and Congress. In addition to advocacy, there's also a liaison function. Neil had mentioned NPL, which stands for the National Public Liaison, which is a division within the IRS Communications and Liaisons. There's a monthly meeting that myself and at least one other member of NCCPAP attends on a regular basis. And that's meeting with some of the higher up individuals within the IRS. And as much as they're sharing information with us, they're also looking to us for feedback. And it's also a means of, in a lot of cases, using these practitioner groups, which really represent the interest of hundreds of thousands of taxpayers, or tax practitioners rather, to really get the word out through our members to just further what the IRS is looking to do. And in addition, we had mentioned that there's been a coalition that's been part of what's been happening over the last few months. probably the third time in recent years that there has been a coalition of practitioner groups working towards a common goal. The most recent was the suspension of notices within the IRS, which has been quite successful. They've stopped sending out a lot of the inappropriate notices, and we still continue working towards penalty abatements, and maybe even, as the IRS keeps pressing us to use first-time abatement, to maybe even have to have a separate version of first-time abatement, maybe a first-time abatement / COVID, or have an asterisk, just some ways to just state that it really wasn't necessarily due to anything that you were working on. Just a little bit of some roundup from the 2022 filing season. One is many of us have attended the nationwide tax forums, and yet again this year they are live streaming those meetings every Tuesday, Wednesday, and Thursday, and they started, I guess, about 2 weeks ago. They generally are pretty well attended and pretty informative as well. The IRS has continued having a major hiring initiative, and just like many of us and many of our clients, it is difficult to get staffing and bring people on. But at this point, they've made 4,700 offers, 1,400 have been onboarded, and there's about 2,500 temps that are still being used for fill-ins. The error resolution system, last year, many of us saw that there was a significant delay in processing refunds, mostly associated with stimulus payments. They've come up with a system where now that's much more automated, and the main part of the recalculation is now happening within the systems. There's still some that fall through the cracks that are taking longer, but that's more of the exception than the rule. So that's been a very much of a positive. Paper returns can be digitized and processed via the modern e-file system. That's been helping the IRS get more returns processed. But as we keep hearing on a regular basis, they're still pretty far behind and actually managed to fall further behind in this current tax season. As far as direct deposit success, 1.2 million refunds were issued this year, comprising about 22% of all returns. 1040X can now be filed electronically for the current year plus 2 prior years, which is a major improvement. Now they just need to come up with ways to process them a little bit quicker than they're getting processed, because it doesn't have the long delays. And we've also been working with the IRS to maybe come up with maybe a couple tiers of electronically filed returns. One being just taxpayer and their child files a return. They realize after that the child claimed themselves, makes no difference on the child's tax return, makes a difference on the parents, but the parents can't really process until the child's return gets amended. That would certainly be one that should be a quick fix. One other point is that direct deposits for prior year returns are eligible for direct deposit. And at this point, amended returns are not eligible for direct deposit, although that may be changing down the line. And finally, as far as where's my refund, that's now available to go in and for 3 years worth of a period to see what's happening with your refund. And in going through, they've made changes where there's some links into FAQs so that if there's a reason that your return setting still being in process, they can give you a little bit of information as to what's going on. At last week's NCCPAP quarterly meetings, we were honored to have the IRS deputy commissioners from small business self-employed give a presentation to those that were in attendance. Part of what they were covering that they have had a lot of employees that have been put the work as far as helping with the backlogs within wage and investments. And that's been helping. But as we know that with so many returns that keep coming in, and it's just a never ending process, unfortunately. One key item that came out both from the June NPL meeting that was reiterated by the deputy commissioners was that at the end of June, the IRS has again commenced the unannounced officer visits to business clients. The primary focus is for unpaid business tax deposits. So they want to make sure that even though in a lot of cases they're being handled by a payroll company, if they're seeing that a deposit wasn't made, they're trying to be much more proactive. In the past, there have been some unscrupulous payroll companies that have absconded with funds, and this is just trying to be proactive to make sure as to what's really going on, and to hit it very early on in the game before it really can get extremely detrimental to the business owner, because ultimately they're still responsible even if their payroll company fails to make the payroll deposits. When the agent is on site, they'll also provide multiple forms of identification, verifying that they truly are IRS employees. They will have a business card with a phone number to Treasury that will be able to verify the identity of the agent that is on site. And that is for their security as well as the taxpayers to make sure that it truly is an IRS person that's on site. That agent will now become your one-stop shop as far as point of contact, where many of the business owners are dealing with waiting for refunds related to ERC from their amended 941 returns. This agent will be able to do a lot of the checking to see what the status is of those amended returns, rather than going through the normal process with calling practitioner priority line on our end. At any point during those officer visits, the taxpayer has every right to say, I'm represented by a CPA, provide their information, or I want to be represented by someone. And at that point, the officer is required to stop their visit. And because at that point, if the taxpayer has right of representation, which would be honored by the officer. One last point as far as this aspect, if someone is going through an audit, they now have the ability to upload documents electronically, and they are able to do that at basically any point during the audit process. It's really helping to get documents processed and make sure that before a final audit determination is made, that any pertinent documents have been submitted. And in the event that there is a determination and it goes to appeals, if there are additional documents that have been determined to have not been included, it basically would get kicked back to that officer anyway. And that's why they're trying to just make that as seamless as possible. And at this point, we do have polling question number 4. And while you're answering polling question number 4, I'm just going to keep flowing along. One of the big issues that I've been talking to the IRS about since probably January has been the new rules for the 1099-K that are going into effect for this year. Started with the American Rescue Plan Act of 2021. And as we're all aware, the 1099-Ks have been required with $20,000 in aggregated payments and 200 transactions. The new rules, the number of transactions goes out the window, and it's $600 in aggregated payments over the course of a calendar year. These transactions now, and this is what's really gotten the attention of many of our clients, includes Venmo, PayPal, Zelle, StubHub, any of those online payment sites. Many of your clients may have said, hey, why did I get a 1099 or a W-9 form from Venmo? That's why. It relates to goods and services. If any of you use these services, you are seeing on them that there is a question that is this for goods or services. And if you do check off that it is for that, you will end up starting the process towards the recipient getting a 1099-K. The IRS did stress the rules for reporting the income have not changed. The only thing that changed are the rules associated with the 1099-K. They had the same commentary several years ago when 1099-K first came out that relates to basically with credit card sales. Well, where are we reporting it? Is it here? Is it here? And the IRS comment at that point was the rules haven't changed. If you have a sale, it's a sale, you need to report it. The difficult part relates to these changes in the 1099-K, because if you sell some personal items, they may not necessarily be, if you sell it at a loss, you really can't take a loss, but you are going to be subject to the income if you start selling these items for profit. So you need to be very cautious as to what people are selling. A lot of sites, even Facebook Marketplace, is really going to be sending a lot of people into having to deal with this item. Now, the IRS did tell us that there will be data matching taking place, and they are anticipating that initially it may be focusing on larger amounts, but at some point they will start trickling down to those with smaller amounts. But the big question remains, and at this point, they have not been able to really give a great answer, but does it go on Schedule C? Probably not, because you're not in the business of selling. Even if you sell tickets for a concert or a sporting event, that's basically not your livelihood, so you're really not Schedule C. Does it go on Schedule 1 of other income? Do you just document it and not report it? They didn't give any pro or con on either one, and that's one that I think there's still going to be more guidance coming out before we hit the end of the year. I was hoping since January that by the time they talked about it, that we would be getting more and more guidance. And at this point, they're really just telling us, use your professional judgment as to how to proceed. I'm not going to profess that we should report it or where we should report it, because that's still to be determined. But if you see a 1099-K for $600 and another client has a 1099-K for $10,000, I'd probably be having a lot more of a discussion right now with the person with the $10,000 1099-K. Bots and artificial intelligence, IRS has really been using these over the last couple months. They've been, when taxpayers are calling in, they have the ability to get some of the bots that are answering calls, setting up installment agreements. They've answered over 5.1 million calls just since mid-June. The bots are also able to be used for CP14 notices, balance due notices, and that program is going to be rolling out a little bit more in September. I know that many of our clients, mine included, have gotten CP14 notices, and the deputy commissioner stressed that the notices themselves are statutory. If the IRS is showing a balance due, they have a certain amount of time that they're required to get the notice out, or else they have issues as far as collections on the back end. They're aware that there has been a batch that have gone out in error, but what they've stressed is that if you look and see that, in fact, the taxpayer has made the payments, you don't need to do anything, that the IRS, when their systems, they get caught up, they'll see that the payments were made and there won't be any follow-up letters. Eventually, once the IRS gets more funding, and will this bill provide this that Mark talked about? No idea, because it's still too new, but they're working on flowing the tax bots into the tax pros, which can actually help us if we're signed into e-services. Right now, they can provide some transcripts, monitor accounts, but only on the individual side. Last point to cover: retirement plan pre-exam pilots. This relates to the tax side of retirement accounts and trying to enhance compliance. And what they've been finding is that they've found that it's more cost effective to do compliance checks rather than enforcement. And part of the compliance checks, they're sending out pre-exam compliance initiatives. They're trying to get, if they're seeing something that may not be correct with a plan, they're sending out notices to the plan administrators, to the sponsors of the plan, saying we need to get some of these items corrected. The program started in June for a 90-day period, and at any point they have the ability to speak with an agent to address and potentially close this case. And they're using it as a learning tool to really try to help tweak the program. At the end of this 90-day window, one of three things will happen. The sponsor gets a closing letter, a limited scope, or a full scope audit exam. And obviously the IRS is pushing to try to get closing letters because it's much more cost effective and just gets everybody on the same page to really just, we're a voluntary tax system. They just want to make sure that without having to go into audits on retirement plans, that they'll actually be able to have some level of compliance a little easier than what they may have now. And I rushed through some of that, but we're on polling question number 5.
And while people are responding to that, Steve, we do have a question for you.
All
the
right, fire
question
away,
is-
Neil.
Okay, what if you filed a paper amended return and have not heard from the IRS yet? Would you consider filing an electronic for the same return that you paper filed, so at least you could get the IRS to look at the amended return?
The long and short of that is no. I would not turn around and file an electronic return. It's one where it's in their systems, and whether it's been on the IRS website, you have the ability to track where's my amended return. So before I do anything, I would start there to see if it's in the IRS system or not. But at this point, if you turn around and have mailed in a return and it's starting whatever process, you submit an electronic return, it may get into the system quicker. It still has to go and get assigned for processing. And if now it's in there twice, you run the risk of things being duplicated. So the long and short is, unfortunately, they really should wait for the processing, which, as we know, can take 12 to 16 weeks, if not longer. So not the answer somebody may want to get, but unfortunately, that is where things are at right now.
All right, thank you very much, Steve. Steve, one other
Yes, sir.
question just to follow up what I spoke to Mark at the end of his. Have you heard anything at the MPO meetings regarding a specific focus of the IRS on looking at returns for audits or reviews?
At this point, the long and short is no, primarily because they're still putting so much of their efforts onto playing catch up that, as we've seen, there's been a lot less audits taking place. And I think what you're going to see, at least in the short term, is when the IRS starts doing matching of tax returns versus filed versus data in-house. You'll see more of the CP 2000 notices and the under reporter notices rather than the audits for the short term. And I would just make sure that you respond as appropriately as possible. Most of those notices now have fax numbers on them so that you can fax the data back in. It still goes into the same workload, but at least you have verification that it was received, and it may get addressed a little bit quicker than if you go in and mail in other documentation and correspondence.
Okay, thank you very much.
If anything does come up that they do have a focus, keep a look where after the monthly NPL meetings, we do have a release that goes out to our members with updates, and it would certainly be addressed there.
Thank you very much, Steve. Okay, we are now going to our last segment of today's program. As you know from the previous ones, we have focused on issues at a specific chapter in a specific state. Well, today we are focusing on the Florida chapter, and as most people are aware, Florida does not have an income tax. They make their revenues on sales taxes, which is practically everything, and fees, licenses, and fees. So nevertheless, today we'd like to introduce everybody to Lynne Marcus, who has been chapter president of the Florida chapter for the last 2 years. She has been in this profession for a while, and she is going to talk about how she has managed her practice over the years. So without any further delay, ladies and gentlemen, Lynne Marcus.
Thank you, Neil. Hello, everybody. Well, Neil, Mark, and Steve are hard acts to follow, but I will give it a shot. But they are just two of the reasons that I find NCCPAP to be such a valuable asset to my practice over the last 10 years. I became a CPA by virtue of not getting what I really wanted. I had in 6th grade a schoolgirl crush on my 6th grade teacher and always wanted to teach 6th grade. But when I had to choose in college my major, if I wanted to teach 6th grade, I had to take elementary education. Well, it was not what I wanted. I wanted to major in math. And needless to say, they said, it's your choice. You either teach or you go for the math degree. I went for the math. And then I thought, well, what am I going to do now? A friend of my parents actually was a CPA and encouraged me to think about accounting because I had done bookkeeping for my parents' business for a while. And he said, you seem to enjoy it. Why don't you look at that? Well, I went to Queens College at night. I worked my way through college. And I took my first accounting class there, and I walked out of that room knowing I was exactly in the right place. The instructor was absolutely amazing, and I became enthralled with accounting. Can you switch? Thanks. So in case you guys are counting, I started when I was 3 years old. I've been in practice for 47 years, and I still have all my original clients. My first 3 clients came to me via New York City's Corporation Council. All 3 of them had just graduated from college, from law school, and started working there and hadn't the foggiest idea of what to do with a tax return, let alone any kind of numbers. One of them commented to me when I talked with them that in law school, they were told they didn't need to know math. Well, I disagree with that idea, but that's what they were told and that's what they followed. So those 3 clients have been with me, as I said, 47 years. I've seen them go through good marriages and bad. with children, grandchildren, and I speak to them during the year, and they've referred lots of clients to me through the years. My clients right now are just like probably everybody else's. They're complex, they're sophisticated, they're business people. Some of them are seniors, some of them are a little bit younger, but they're probably clients just like you have. I was in New York until about 20 years ago. I moved personally to Florida in 2002. And I'm still in Florida, obviously. I still have many of my New York clients, and I've added to my client list with Florida people as well. And they're pretty similar to the New York clients. Okay, Luke. Thanks. My clients, as you can well imagine, after knowing them 30, 40, almost 50 years, really aren't clients anymore. They're friends, they're family, especially during tax season. I'm so glad to see them physically. I do go up to New York every year for tax season, and my clients, many of them call me at the beginning of the year, "Are you coming up to New York?" I care about them. They know I care about them. I want to make a difference for them. That's very important to me. I want to keep them honest. I want to keep them out of trouble. Some of my clients had been getting letters from IRS, from New York State. And once we got started, those notifications and letters have stopped in most cases. So I really like a challenge, as I'm sure most of us do, trying to get the best situation for a tax return, trying to balance financial statements. Sometimes that's an impossible chore, but we try. And I really do like a challenge, and that's what accounting brings to me in addition to the math. Okay, Luke. In the mid 1980s, my clients started coming into me with investments that we hadn't really talked about before. And their comments were, "We trust you. You know us best. Help us." There were things like limited partnerships for oil and gas, for real estate, insurance investments, in annuities, in long-term care. Well, I knew what I thought, but I wasn't sure that I had enough knowledge to give them really good answers. So I thought about it, and I realized that if I couldn't give it to them, they would find somebody who could, who may not be honest, who might be honest, but they certainly weren't working with me as their CPA. So not only would I lose financial business, but I would lose some of my accounting practice. Not something I wanted to deal with. So I looked into getting a certified financial planner license. I spoke to people at the College for Financial Planning in Denver, and I worked with them. And a year and a half later, I had a CFP license. About a year after that, I got a call from the continuing education officer at Queensborough Community College, which many of you probably know of in Queens, New York. She wanted the CFP program brought into Queensborough. It was previously at Queens College. And lo and behold, Queens was dropping the program. We brought it into the community college, and I ran the program and taught the first course for several years, and was able to get very good colleagues and friends to teach the other 5 courses. Knowing that I was doing this, the college used to get calls from all the major banks in New York City, Chase at the time, chemical manufacturers. They wanted to teach their platform people financial planning because they felt it was a moneymaker if they could refer their clientele to the financial planning people in the branches. And so I was asked to teach all of these courses. I was the only one that was recommended to the big banks. And that lasted for several years as well. Okay, Luke. All right. So financial planning certainly has become part of my practice. At this point, I am a little bit older. I'm not looking to grow in an extended way. I certainly take on new clients, but I'm not looking for a $500,000 practice or more at this point in my life. Someday I may want to retire, although right now it's extremely unlikely. I don't do any marketing. Most of my business comes from referrals. And I do stay in touch with my clients, even, as I said, those that are C and D clients, because they've recommended good people to me as well for clientele. What I do is talk to my clients frequently during the year. I send them cards on birthdays and special occasions. It's very important to me to know what their businesses are, to know about them. And I send them news items and I do research on their practices. I had one client come in this year for his tax return. He's been with me many, many years. And he's had problems with a former wife of his father, a second marriage. And this year, due to all the litigation that have gone on between them, he had gotten information that she was filing fraudulent tax returns. And how could he report that to Internal Revenue? I contacted IRS for him and gave him some information. But oddly enough, about 2 months ago, I saw something in the e-news from IRS that we all get about their whistleblower department. I called him immediately, and he was so thankful and so pleased that I had even thought about him after tax season. And I do. That's the kind of thing I want to do with my clients. I send out mid-year letters. I send out year-end letters. I write them because I know what my clients want to know about, what might be of interest to them. And I find that most of them do read it, although sometimes I get them back with the tax information with the envelope sealed, I must admit. I have done special events for my top clients. I've had barbecues at my home. I've taken clients, financial planning clients, to the New York Stock Exchange so that they get an idea of what's happening on the floor, even museums. So different occasions, different events. And I think connecting with people that you want to meet is a good strategy. If you know someone who knows somebody else that you really would like to meet, ask them. I think it's very important to meet people in different ways, whether they should be clients or just referrals or just sources of information. I find that really important. Okay, next slide, please. Okay. We all need to know our clients' businesses, what their challenges are, including legal and tax ramifications. You can't work with clients if you don't know who they are, what their businesses entail, because you could spot things that they aren't even aware of. And I'm sure most of us do. And certainly through the years, I've learned about businesses. I've learned about their families. They've become family. And during tax season, to me, it's like a big family reunion. And I really, really look forward to it. They know how much I care about them, and they call often. I've gotten a lot of them trained to call me if there's anything different going on. Call me during the year, not surprise me at tax season. And you have to be consistent. I personally try to keep contact with people, with my clients, because the Zoom is wonderful. The computer is great. Email is terrific. But I like that I can talk to them. I can see them. To me, that's a whole lot more important than seeing them on Zoom or sending them emails. You know, I find people either they like you or they trust you. And if you can get both, then you'll have that client forever and they will refer to you business ongoing. Next slide, please. So despite the fact that I started at 3 years old, I'm certainly not planning on exiting anytime soon. I love what I do. I have no idea what I would do with my life, in all honesty, without my practice, without being able to see my clients. They're getting older. I'm getting older. I know at some point I probably will have to stop. Hopefully not in the near future. I would assume that it's at that time I'll probably look to join forces with someone younger than me who plans on being in business for a while, somebody who has similar philosophy to me. And that's going to be really important for what I do later on. I had a client come in last week, in fact, and it sort of coincided with a doctor's appointment for a checkup that I had last week as well. It was very ironic that the two happened pretty much at the same time. I went into the doctor and I never saw the doctor. I saw the PA. And that to me is not why I go to see a doctor. Well, this particular client came into me and we were talking for a while. He usually sits here and we talk for about an hour and a half before he leaves. And he said to me, you know, I've used other accountants, which kind of surprised me. But then he said, I would never stick with them because what's important to me is that I get answers to my questions and that I can know that the person I'm working with, I can trust, that they don't have to go do research, that they have answers for me, not that they have to go back to the partner to ask the questions and do the research. He said, with you, I know I'm getting the right answers and I will never leave. Please don't retire. So for now, I guess I'm still totally dedicated to my practice and my clients. I still go to New York City during tax season, or if they need me, I'm certainly there. I certainly can get on a plane and help them with any IRS or New York State audit. So I think that's where we leave off. That's pretty much my practice. And I'd love to hear from some of you.
Well,
Thanks so much.
Thank you, Lynn. We now have polling question 6 up, and we do have a question for you, Lynn. I might have missed it, but I'm curious. How long ago did you become a CFP?
I became a CFP in 1988. And I got my CPA license in 75.
Okay, thank you.
Thank you.
Okay, we do have one other question. I know, Mark, you answered this online already. But let's just for everybody. Somebody asked about the electric vehicle credits. The current 7,500 is good on vehicles with a written sales order before the bill is signed into law, and then the new calculation takes place. Is that correct?
Right, and that is my understanding currently, but you know, Dave's question there dovetails into what his concern is, which I put it in the Q&A, but I'll kind of go through it. Understand what I was saying before. The various credits in this bill are to push domestic production, okay, and domestic energy. For example, this credit, and I'll just kind of read through it, credit is eliminated or reduced if a certain percentage of the minerals utilized in battery components are not extracted from a country in or recycled in North America. Credit is also reduced if the EV is not assembled in North America, or if the majority of the battery components are sourced outside of North America, and on and on and on and so forth. So in any of these credits, you not only have to be looking into, is it a vehicle that's normally eligible as an energy efficient or electric vehicle, but if it all now meets this domestically produced or components domestically produced standard. So that's very important. You really guys have to really, unfortunately, kind of what I said before, you're going to get a question from a client that says, hey, I heard that there was this credit out there, or more likely, I already bought this and I was told there's this credit out there. And you're going to have to tell the client, yes, the credit's out there. I have to go and I have to look at the provisions and see if it's applicable to you. Because there's no practitioner here that can memorize and know every aspect of all these credits. It's impossible.
And that is one of the great benefits of this organization, is that we can always reach out to our member. We can always reach out to other members for answers. We do have another question. I guess this will go to Steve. Taxpayer has not received their 2020 refund yet. After repeated unsuccessful attempts to communicate with the IRS and the taxpayer advocate via letters and phone calls, what do I do now?
There's a couple things. One, how was the return filed? Was it filed in paper? Was it filed electronically? Do we know that it's been accepted? What comes up in the where's my refund if you go and do that level of search? Keeping in mind that in many cases, taxpayer advocate has actually gotten overloaded as well. If this return hasn't been processed for 2020, meaning it's been accepted but still shows as being in process, the CPA is going to need to have a power of attorney in order to discuss any aspect of the return with the IRS, because even if it at that point, any third-party designee really wouldn't be helping any aspect of trying to get information. That this is a case where they would need to have a true power of attorney in order to discuss what's going on.
Okay, the
So
person who made a couple of comments, it was filed electronically, it was accepted, and it is still in process when they check on where's my refund.
So that's the case where it's probably stuck in one of the error resolution codes.
Yeah.
And what you're going to need is to have a power of attorney in order to get through on PPS line to try to figure out what's going on. It's not an easy process, but it's one where that's the steps that they're going to need to go through in order to really get any further along.
And we have another comment on that from someone else. I will give kudos to the IRS callback system. If I'm successful to get into a queue, the callback is received and close to the estimated time.
Yeah.
I concur with that. I've seen that a number of times. The only downside of the system is that it's only able to take up to so many calls into that specific queue, that if their lines are fully bogged down, then you're not getting the ability to use the automated callback system. But I do suggest at any time that it's offered, you take it. You might as well. The call is going to come back, and at least then you're not sitting there on hold with either a headset or a speakerphone going, and you can actually walk away from your desk for a second if necessary and do whatever it is with other clients that you may be working on at the same time.
Thank you, Steve. We do have one more question, and it is, how do CPAs, and this would be for everybody, how do CPAs with similar situations to Lynn find a like-minded younger CPA in their area to work together to carry on a smaller tax firm?
Well, the first answer, Neil, would be self-serving, which is come to local NCCPAP meetings. Right?
True.
But no, it's true, okay? And by the way, whether it's a NCCPAP meeting, you go to an AICPA meeting, some of the organizations meetings, you get obviously a lot in person out of what the speaker is talking to you about, but you really get the most out of talking with your fellow practitioners during breaks, at lunches and such. And that is how you stumble upon new people to potentially do business with or pass your business along with. Those conversations often get started at, could be the annual tax update meeting, but you found the next practitioner you're going to decide to work with. So sounds self-serving, but not just for our organization, especially now the meetings are going back out live, try to get out there and meet up in meetings. That's the best way to hook up with new folks.
Okay. Well, thank you, Mark, Steve, Lynn, thank you. We need to wrap this up. So very quickly, I know that there are a few people who have participated today and in our 3 previous who are not yet NCCPAP members. And obviously, I want to encourage you to become a member. This is a great organization. If you get into it and you get involved, you will get a lot back out of it, a lot more than what you put into it. We do have another NCCPAP Now coming up at the end of October. There are other events. Check your local chapters for what's going on. Things will be coming out through national. There is the tax symposium in November. The Florida chapter is having a big event with the ACFE and the AII in October, an all-day event. And of course, the next national meeting is in Dallas, October 26th, 27th, and 28th. So on behalf of Lynne Marcus, Steve Mankowski, Mark Stewart, I want to thank everybody for attending, and we will see you in October. Have a safe and healthy tax season, I don't know, 2.0, 3.0. We have to get through September 15th and October 15th. Good luck, everyone, and goodbye.
Great. Thanks, everybody. Have a good week.
Take care, everybody.
Thank you.
Bye.